Dividend stock investing. There is no one right way to do it. In fact, I want to share in the video today with all of you 7 different strategies around dividend stock investing, 7 different investing personas, if you will. I have been here on YouTube for a very long time. I'm one of the original dividend stock investors on YouTube. I want to share today, over the years, all of the different strategies that I have been exposed to as a stock market investor and how they've all informed my own strategy. Because again, there's no one right way to do it. And there are 7 different ways I want to share today that are amazing ways to develop, to cultivate, to grow passive income from dividend stocks. Let's get started with the first one. As you can see on the screen in front of you right now, the first strategy I want to share is the classical dividend growth investor, blue chip dividend growth investor. This is the one we are all really familiar with. This type of dividend stock investor typically invests in the Dividend Aristocrats. Dividend Aristocrats, for those that don't know, are blue chip dividend stocks that are in the S&P 500. Typically, they have a market cap, I believe, of $3 billion or larger, and they have grown their dividends consecutively for 25 years or more. These are stocks like Johnson & Johnson, PepsiCo, McDonald's. In fact, what I want to share with you right now on the screen is Johnson & Johnson, because this is the perfect dividend stock that fits this bucket of the blue chip sleep well at night strategy. You can see that Johnson & Johnson, over very long periods of time, the stock chart is up and to the right. You can see that it has a minimum of volatility. It's only down 11.5% from the 52-week high, despite having litigation risk right now. Despite having some litigation risk, still the stock is not all that volatile. You can see it presents a little bit of value here. I'm actually excited to see that PE in the 15s forward basis this year, 14s next year. I would say out of all of my core blue chip growth oriented dividend stocks, this one is probably presenting a little more value than the rest. You can see that it has a payout ratio of 44.7%. They're paying out less than half of their earnings as dividends, but you can also see that the 5-year dividend growth rate, it is only 5.7% per year on average, and I would say that's probably going to trend down over time. The key takeaway from the screen here is that a starting yield of 2.93% and a growth rate of 5.7% per year on average is a slow way to reach FIRE, financial independence, retire early. So there are so many benefits to this first strategy. The first of 7 today, this blue chip dividend growth investor. The benefits of this strategy are the sleep well at night component to it. It is the minimum of volatility. It's that it fits a lot of risk profiles like my own that are lower in risk tolerance. But the downside, I would say, of this particular strategy is it really is get rich slowly. It takes many years with starting yields in this range and growth rates in this range. Even with full reinvestment, even with throwing a lot of money at the problem, it takes many years or even decades to reach FIRE with this strategy. But I love this strategy because it anchors my portfolio. It's one of the most prevalent strategies in my personal portfolio because it is adjusted to my own level of risk tolerance. My risk tolerance is a bit lower. I love these blue chip sleep well at night stocks. They keep chugging along. They do what they're supposed to do, and they do it with a minimum of volatility. But I want to share 6 more strategies in the video today because my own portfolio, it's informed not just by the first strategy, but I have layered in components of all of these different strategies to produce a well-rounded portfolio. Check it out on the screen right now. The next strategy that I want to share with all of you today is the rapid growth dividend stock investor. The cool thing about this strategy as compared to the first one is that the dividend growth rates are, as the name implies, a lot more rapid. Typically with this strategy, it has a low starting yield, but the rate of growth on the dividends is really high, like 8% per year or more. And a lot of these, it's even 10% per year or more. Typically, the types of investors that gravitate towards this strategy are those that are not trying to retire quickly. They have some years and they're willing to wait, and they're trying to optimize long-term yield on cost. And one of the benefits is low taxes in the short run. Now, the downside of this particular strategy is that sometimes these companies, they don't live up to our expectations. You might remember, if you've been on my channel for a while, a few years ago, I realized in my portfolio, I had a little bit of deficiency of this particular strategy. I had a little bit of deficiency of these rapid growth dividend stocks. And so I started adding a few of them. And of the ones that I added, I would say so far, none of them really, maybe other than one that I'll discuss later in the video. It falls into this strategy, but it also falls into another one. Most of them haven't lived up to my expectations. And as you can see on the screen right now, a perfect one is Church and Dwight. I like this company. It's a great company. I continue to hold it. I continue to reinvest dividends. But here's what's fun about Church and Dwight, CHD. Over the last 5 years, the dividend growth rate has only been 4.6% per year on average. But on the 5 years prior, it was 9.2% per year on average. And so what can happen with this strategy sometimes is the investor is looking for these low yielders that are low yield in the short run, but can offer a huge yield on cost in the long run because they're growing the dividend really quickly. Well, I looked at Church and Dwight because I saw that the dividend growth rate was really high. But since I've owned the stock, the dividend growth rate has dipped quite a bit. And so that's a pitfall with this particular strategy. But not all of the companies are like that. Some of them will continue to grow dividends quickly. And some of them, maybe even like Church and Dwight, will go through cycles. There will be periods of slower dividend growth, periods of higher dividend growth along the way. But as you can see on the screen right now, I want to share what's so interesting is I'm not really a fan of this strategy in 2023 because we live in a macroeconomic environment that's uncertain. We live in a macroeconomic environment where I would say winner takes all. Blue chip stocks are kind of trumping some of the smaller stocks, if you will, these days. But I would say that I like this strategy when there's overlap between it and the first strategy, the blue chips. And I have a few examples here of Starbucks, which is growing the dividend on average by 12% per year, and the Home Depot, it's growing the dividend by 15.2% per year on average. And so this is an important takeaway from the video today as well. I've only gone through 2 of the 7 strategies so far, but oftentimes you will find overlap between the strategies. And one area of overlap already that I've identified that is really fun is when there is a blue chip sleep well at night stock that also has characteristics of the second bucket, which is the rapid growth dividend stock bucket. But I'll tell you, historically, when I think of bucket 2, the rapid growth dividend stock, I've always thought in my own mind about the smaller companies, the small caps, the mid caps. And I'm just trying to say those stocks in particular for me, over the last few years, they have been underwhelming. This second strategy hasn't performed quite as well as I would have thought a few years ago. But one last point I'll leave you on with the second strategy that so many investors love is if someone believes they're going to live off of dividends, say in 20 years, but not until then, the beauty of this strategy is it optimizes taxes. Fewer dividends in the short run means fewer taxes in the short run, and the dividend will compound and grow over long periods of time because of the quick dividend growth rate. And so it really optimizes taxes for later, for when the investor actually is going to take the cash flow, and the investor doesn't have to pay a ton of taxes in the short run because the starting yields are so small. But one thing I would say about this strategy, if the investor went all in on it, the downside is if I had a bunch of low yielders in my portfolio, let's say I changed my strategy and I was like, hey, yeah, I thought I was going to retire in 20 years, but no, I want to retire now. This strategy does not provide a lot of flexibility. So I want to go into the third strategy. As you can see on the screen right now, the third persona of dividend investors, or the third type of dividend stock investing strategy that I see all the time, and I fall into actually a little bit of every bucket that I'm discussing today. Of course, the one I fall into probably the most is the first bucket, but I fall into this bucket as well, the dividend stock collector. This type of investor typically owns a lot of positions. That's me. This type of investor takes great pride in the positions owned and often uses the brands day to day, takes great pride in just seeing in the real world, like when I'm traveling or just driving around town and I see the Coca-Cola truck, for example, I get excited. That is a clear sign that someone may be a dividend stock collector. This type of investor also may sometimes rationalize buying positions, kind of just because, hey, I want to add that position to the collection. I'd say that's a downside possibly of this type of strategy. And one of those stories in my own portfolio is Marriott Vacations Worldwide. This is one of the stocks that I discussed on my channel a while back. I'll link to it in the pinned comment below. It's actually one of the more controversial videos, believe it or not. I thought it would be one of the most fun videos because I was just talking about travel and travel experiences. But needless to say, check out the pinned comment and you can watch the video and look at some of the comments. But I bought this stock because I have a passion, personally speaking, for the product that they sell. Now, this dividend stock is awesome. It also falls a bit into bucket number 2, the rapid growth bucket, because on the 5-year basis, they're growing the dividend on average by 12.5% per year. So you'll see that these buckets, these 7 buckets described today, they are not mutually exclusive. There is overlap between them. And so I have a stock I purchased as part of my collection, and it's definitely a dividend collector stock for sure. It's a smaller position. It's a collector stock that I bought just because I wanted it in the collection. I have a lot of passion for what they sell, but thankfully it also falls into the second bucket with that very fast dividend growth. But I'll tell you, the downside of the dividend collector is that the dividend collector sometimes can rationalize buying stocks that may not make sense if the same investor looked at things a little bit more objectively. The dividend collector also gets into trouble when the collector is really good with numbers and can rationalize almost anything through Excel modeling. Because all of us know that there's enough data out there where if a company is pretty good, we can make it look really good when looking at the numbers the right way in Excel. And so sometimes the dividend collector falls into that pitfall. The pros, though, of being a dividend collector is that the dividend collector can hold on strong to those stocks through any kind of turbulence, because the collector looks at the stock not just as a source of passive income, but almost as part of the family, as a treasured kind of family heirloom, if you will. The dividend collector, you're not going to find that collector parting ways with his or her favorite positions, if you will. And so that's one of the great things about being a collector and why I try to harness that strategy personally, because I love the companies, the stocks that I invest in so much. It is agonizingly painful for me to try to sell any position. Put in the comments below, by the way, do you fall into any of these personas that I'm discussing today? Do you fall into all of the above? I would love to know. And I always check out all of the comments. I try to respond to most of them. I really appreciate them. But let's keep going. I want to move on to strategy number 4. As you can see on the screen in front of you right now, I want to share the European dividend stock investor. And so, boy, there are so many smart European investors out there. And what I would say at a high level, just from my own stock analysis, is I feel when the investor is looking at European companies, there's just a little bit more of analytical rigor that is required, because the data set that is oftentimes provided from these companies, at least as a US investor, when I look at it, it's a little more tricky to decipher. It's a little bit more challenging to get to the bottom of things, if you will. And I have run into some of the most incredibly analytical and numbers savvy investors in the European dividend investing community. And I want to give a shout out to European DGI. He's over on Twitter and he's also one of the co-hosts of the Dividend Talk podcast. Speaking of Dividend Talk podcast, I was invited back to that podcast for the second time recently. We recorded a podcast. Actually, I'm going to have European DGI here on my channel as well as a guest sometime in the future. I can't wait, but I want to link in the pinned comment below to that resource. I hope you check out that podcast episode with yours truly. I also, though, want to give a shout out to Dividend Wave. I believe Dividend Wave is also a European investor. I hope I'm not getting this wrong, just because I believe there's a European flavor to his posts over there on Twitter. So check out Dividend Wave. I am always on Twitter. I am always so impressed by all of the analytics and the charts and the data that is presented from Dividend Wave. But let me keep going. As you can see on the screen right now, the reason I'm bringing up the European investor as a distinct persona is whether you're from Europe or not, I think it's important for all of us to harness our inner European investor because it takes our analytical rigor to the next level, and it exposes U.S. investors to these global companies that we would have never heard of before. I'll tell you one that European DGI was telling me about is this company called Ahold Delhaize. I hope I didn't mispronounce that. There's an ADR in the U.S., ADRNY, and they actually own a very large supermarket chain, not only in Europe, but in the US, the Food Lion and Giant brands of supermarkets. And honestly, I was looking at this company. I wanted to put together some stats for the video today, but I just couldn't even get to the bottom of even their dividend history. That's what I'm saying. There's a level of analytical rigor that is just a higher standard for European investors, and I respect that. And the European investors bring all of us to a higher level of knowledge in this community. One thing worth noting, I own a bunch of European stocks. I own Unilever, for example, SHEL. I own British American, ticker BTI, one of my SIN stocks, a high yielder as well. I'm going to get to this later. There's some overlap between some of these buckets. I'll tell you, Unilever, for example, I look at that as kind of a core blue chip dividend growth traditional company. It falls into bucket one, for example. Anyway, those are some of the ones I own, and those ones actually, I believe, all pay quarterly, but some of these companies like Ahold Delhaize, for example, when I look at these companies, they'll pay semi-annually. And so that's something for the US-based investor to understand is sometimes with the European stocks, they pay semi-annually. But I love the fact that I'm a global investor. I own companies and stocks from all around the world that participate in economies all around the world. That is for my own diversification and global investing strategy, which falls all the way back to bucket one, blue chip stability, quality. I think quality and stability oftentimes come from a global presence and not being isolated to any single market. And so I've got a lot of respect for my friends who are European stock investors, and I have a long way to go to learn as much as European DGI knows about those types of companies, but I am slowly and surely getting there over the years, and I'm so proud to own some European stocks. And with that, I want to move on to the next bucket of distinct kind of persona of dividend stock investors. And as you can see on the screen in front of you right now, this is bucket number 5, and this is kind of similar to the last one, but this is the Canadian dividend stock investor. I like to harness my inner Canadian dividend stock investor all the time, and I own some Canadian stocks. But first and foremost, actually, I want to give a shout out to Brandon Beavis. He's my favorite Canadian investor. Brandon Beavis has a YouTube channel, which I'll link to in the pinned comment below. I'm going to link to a ton of these resources in the pinned comment, so please make sure to check that out. I'm going to link to some of my videos and also some of these other resources that I'm mentioning. But on Brandon Beavis, he has an investing academy for Canadian investors, and I am really grateful that sometimes I do guest present there. And later this month, at the end of the month, I will be guest presenting live once again, and I'm going to be going through some dividend stock metrics that I like to look at when I analyze dividend stocks. But shout out, man, Brandon Beavis. But I want to keep going. As you can see on the screen right now, one of the things I love about Canada and Canadian dividend stock investors is these investors oftentimes remind U.S. investors about higher yield. And so I look to the Europeans to remind me to be more analytical and more numbers driven. I look to the Canadians Canadians to remind me, Ian, don't forget about the high yield. Don't only look at these long-term rapid dividend growth stocks, quote unquote, like Church and Dwight used to be. These Canadian investors remind me to look at the stocks I own, like BMO, Bank of Montreal, with a 4.88% starting dividend yield. Now, there's no tax treaty between the US and Canada, so I have to pay foreign withholding tax on that, but I can claim it back as a credit as well. Of course, I'm just speaking to my personal tax situation. Of course, I'm not offering tax advice. It's important to consult with your licensed tax advisor. I'm just sharing my personal journey here. But one of the important nuances is with a lot of the European stocks, like a British American, which trades on the London Stock Exchange, there is a tax treaty between the UK and the US, so there's no foreign tax withholding on that particular issue. But when I'm dealing with Canadian stocks, it's not the same. There's foreign tax withheld. But again, from a tax standpoint, speak with your own tax advisor. But in my personal situation, I'm able to claim it back as a credit. So that's one nuance that's important. But as you can see on the screen in front of you right now, the Canadian investors always remind me to look at higher yield. One of the things, too, is that the Canadian investors always remind me that there are neat opportunities out there, not only in Canada, but worldwide. And don't forget, don't just be blinded by these big blue chip companies like Johnson & Johnson. Ian, don't forget, there are stocks out there like Alimentation Couche-Tard, which owns Circle K convenience stores and gas stations all throughout the world. I bought this one, ticker ANCTF. They are offering, or they have offered over the last 5 years, a rapidly incredible, mind-blowing 25.5% dividend growth rate per year on average. So not only is this one a Canadian stock, but it also falls into bucket 2, which is a rapid growth dividend stock. And this is one of the few rapid growth dividend stocks. It's kind of a smaller cap that I bought a number of years ago when I was buying Church and Dwight. This is one of the only ones that actually fulfilled the promise of what I thought it would. It lived up to the expectations, and it continues to. They are one of these stocks where the starting yield is really low, but they continue to grow that dividend each year just like crazy. It's amazing. I love that one. And a fun fact, someone first brought this up in one of the comments on my YouTube channel a number of years ago. They said, Ian, what do you think of Alimentation Couche-Tard? Or what are they were calling me like Couche-Tard. And I'm like, wait a minute, are you trying to insult me here? What is this? I thought they were calling me names, but no, I looked this thing up and it was a company. I ended up buying the company. That's how fun this is. And the Canadian investors always remind me that there are these hidden gems out there. And another one is the A&W Revenue Royalty Trust. I looked into this one for so many hours after my friend Brandon Beavis brought it up in one of his videos. The way it works is A&W, the root beer company, they also offer fast food restaurants, both here in the U.S. and in Canada. I actually went to A&W today, believe it or not. I had a root beer that was made there on premises. Wow, it was delicious. And I had a burger. It was good. It was really good. But in Canada, their menu looks even better, actually. All their meat is like grass-fed and everything's healthier and better. I can't wait to go to Canada to try out A&W there. But the story with A&W in Canada is it's a separate company, and the way it works is for investors, they can invest in what's called this revenue royalty trust. And there's an agreement that top line revenue, a percentage of that goes to the trust, and it just gets paid out as cash flow. What an amazing hidden gem opportunity. And so I was looking into this. It's right in my wheelhouse. You all know I'm obsessed with fast food, those types of stocks. I own Starbucks. It's my largest position. McDonald's is my number 4 largest position. You know I love those. But I could not buy A&W because on the U.S. side of things, the taxes are just too complicated. These revenue royalty trusts, they fall into a very specific subsegment of the tax code in the U.S. And my level of sophistication, it's just not up there where it would make sense for me to invest in something like this. But I got to say, if I were a Canadian-based investor, this is one, I just thought the company was so amazing. And so anyways, Europeans remind me to be analytical. The Canadian investors, and I run into so many of them on Twitter and on YouTube, they remind me to think of both higher yield but also these hidden gem investments. But I want to keep going. I've got 2 more personas. Check it out on the screen in front of you right now. The next persona is the high yield investor. And there are so many sub personas of the high yield investor. But the first one, of course, is the Thug Life Sin Stock investor. I love the Sin stocks. What's so fun about this investor doesn't care what others think. He or she just sees value in the Sin stocks and goes for it. But there's other types of higher yield investors. There's the covered call ETF investors. I've been planning on adding XYLD back to my portfolio. I haven't done it yet, but I still plan to. The starting yield on trailing 12 months distributions is 12.1%. There are investors in this particular strategy who go after closed-end funds. Stephen Bavaria, in his book, The Income Factory, he talks about those a lot. I'll link to my video review of that book below. Fun fact, I actually bought a closed-end fund. I discussed that over on Corner Patreon. I will link to that in the pinned comment below as well. On Corner Patreon, I share my stock portfolio, my percentage allocation to each position, and my dividend stock portfolio. I also share my bond portfolio and my percentage allocation to each position over there. In the bond portfolio, I ended up buying actually a closed-end fund. It's a smaller position, a much smaller position, but nonetheless, it's a Stephen Bavaria type position. My friend Greg, I interviewed him here on my channel now, 3 separate videos actually, I believe 3 videos. And most recently I did a 2-part video interview with Greg. I'll link to those in the pinned comment below. He's the Dividend Monster over on Instagram. I'll link to that resource in the pinned comment as well. He's a high yield investor as well. And what high yield investors like to do is basically they're about show me the money now. They don't necessarily want to wait years in the future for the compounding to happen. They just want the income now. A lot of these investors want to retire immediately. Others, though, who don't even plan to retire immediately feel more comfortable just having most of their returns come from distributions that could either be spent or reinvested as compared to growth over long periods of time. They just feel safer with show me the money right now. And one of the reasons I respect that strategy so much right now is the Church and Dwight example. I placed some promise on Church and Dwight back in the day thinking that, hey, they're going to grow the dividend really quickly. Well, as soon as I bought them, the rate of dividend growth slowed. This is one of the arguments that higher yield investors use just to go for high yield because they don't have to worry about dividend growth. They already have had a high yield. They don't need the high yield to grow. There's less complexity in some ways in the worry that gets put on the future with the high yield strategy. And how I've harnessed the high yield strategy in my personal portfolio is largely through Sin stocks and also looking just within my portfolio and trying to pick and choose some of the higher yielders like Bank of Montreal, which falls into the Canadian bucket as well. But I want to keep going. I have my 7th persona to share with all of you today. As you can see on the screen in front of you right now, the last type of dividend stock investor, last type of dividend stock investing strategy that I wanted to go through today is the ETF investor. ETFs, or exchange traded funds, allow investors to buy a basket of stocks with a single trade. A lot of these investors like to set it and forget it. There's less focus on the individual stocks, more focus on the big picture. It frees up time. There's less analysis, less individual risk on any particular company, which I think is really important in 2023 because there's more specific company risk than ever before in our politically charged environment that we live in right now. I would say in terms of cons, it's not as fun as, especially for someone like myself who likes to collect stocks. You have to rely on a middleman. You have to rely on that ETF company making good on their promise to run that ETF as they should. And there's going to be some turnover and some fees related to the ETF. Whereas with individual stocks, I can kind of minimize fees and turnover by just buying and holding forever. But I would say the biggest con with ETFs is you can't really cherry pick individual stocks like I can. At any given time, I own 50 stocks. One of them or 2 of them might be on sale. I can cherry pick those stocks, but the ETF investor is buying a basket of stocks. Now, the most popular ETF that I hear about all the time on YouTube is SCHD. This is the Charles Schwab dividend income-oriented ETF, and I plan on actually buying that. I still haven't yet, but I do plan to do that in 2023. And as you can see on the screen in front of you right now, that one is yielding right now 3.77% based on trailing 12 months dividends. And there's only 31% overlap with my existing portfolio, so I'm adding for instant additional diversification. I would say for me, the most compelling component overall of the ETF strategy, and there's some overlap here with the closed-end fund strategy as well, because I've heard my friend Greg talk about this. The most compelling part of it for me in 2023 is de-risking the portfolio and taking away from specific individual company risk. Because when I go all the way back to the first bucket, some of my core blue chip stocks that I own, like Johnson & Johnson, Starbucks, they comprise an enormous portion of my portfolio. And that's good because I'm betting on my favorite stocks, but in some ways it's bad because it creates risk. Because if something really bad or terrible were to happen with J&J or Starbucks or McDonald's or Pepsi, those are so big in my portfolio that it would be felt. I would feel that impact overnight. But with SCHD, if any one stock collapsed, I wouldn't really feel that impact. And that's one of the benefits right now, because we're seeing companies more so than ever before get attacked in the media. And so there's a lot to be said for the ETF persona. All right, everyone, if you enjoyed the video today, please go ahead and click the like button. And after you do that, head on down to the comments and put in there, what type of investor are you? Do you fit any one of these personas, more than one of the personas? I'm a little bit of all of these personas, but of course, my top two, I would probably say, would be the core blue chip dividend growth persona. I would say it would be followed up with a little bit of thug life high yield in there. Those would be the two probably I gravitate towards the most, but I got all of these in my portfolio. And before I go today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Also, today's video, it's not tax advice. I'm not a licensed tax advisor. Again, just sharing my journey for fun and entertainment. Before I go, in terms of full disclosure, I own the stocks mentioned today. I talked about a lot of stocks, so I hope I don't forget any, but if I do, I'll put them on the screen. I am long Johnson & Johnson, ticker J&J, PepsiCo, PEP, Starbucks, SBUX. I'm long McDonald's, MCD. I'm also long Church & Dwight, ticker CHD, Home Depot, ticker HD. I'm long Marriott Vacations Worldwide, VAC. I'm long Unilever, UL, SHEL, SHEL, British American, BTI, Thug Life. I am also long Bank of Montreal, BMO, Alimentation Couche-Tard, ANCTF. I plan on adding XYLD. I plan on adding SCHD as well. I own those stocks in my personal dividend stock portfolio. I have new videos on the way all the time. Don't forget to subscribe. I really appreciate all of you who hang in here until the end. It's late at night on Friday night. I've been very busy at work lately, and so I work so hard to produce these videos for the community. And those of you that make it to the end of the video like you are right now, it really means the world to me. I love you all. Thank you for watching, and I'll see you in the next dividend stock investing video.